Stocks trade in a narrow range following conflicting signals from US, China on trade. Pharma, IT gain, while realty, FMCG drag. Mid-caps fare a tad bit better.
Hindustan Unilever posts a tepid quarter but expects the first half of FY26 to be better than the second half of FY25. Although gross margins will crimp on higher investments, Tata consumers see double-digit growth as a given and better margins if tea prices ease.
Lupin gets a nod from the US FDA to launch tolvaptan, a drug with US sales of nearly $1.5 billion with 180 days of exclusivity. Analysts estimate a revenue potential of up to $200 million in FY26 from the sales of the drug.
Tata Power CEO Praveer Sinha sees an opportunity to supply solar modules to the US and other markets and is contemplating capacity expansion for this. He also expects to have a nuclear unit ready by 2030.
Hello and welcome to Halftime Report. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar and with me is Hormus Patakia. Hi Hormus, we've just got the management of Persistent waiting by to chat with us.
Indeed, and we will get to that. And it was a strong quarter from Persistent Systems and the stock is doing well for itself as well. Now, to discuss this in detail on the fourth quarter results and the outlook going forward as well, Sandeep Kalra, the CEO of the company, is joining in. Mr. Kalra, good afternoon. Thank you for joining in. You know, you registered a strong quarter, but was there any impact on the business in terms of deals being paused, or did you see any ramp-ups or deal closures getting delayed? What's the sense on ground right now?
At a high level, if you look at the quarter, we delivered $375.2 million. This is 4.2% quarter-on-quarter growth, 20.7% on year-on-year basis. In full year terms, it is $1.409 billion, 18.8% year-on-year. Now, coming to your question, the macro did get tougher, and the last 6 to 8 weeks have been fairly, interesting from a macro perspective, with all the discussions about DOGE, USAID, tariffs, etc. There are pockets where obviously the impact is being felt, whether it is the decision making being delayed, certain amount of deal flow getting slower, and people getting a little bit more cautious about where they want to spend money. So yeah, we saw some amount of that, but from a revenue perspective, and I would say to a certain extent from an order book perspective, we delivered very well. It could have been better from an order book perspective, but look, the macro is the same for everyone, and we hope that this stabilizes and bodes well for the IT services industry. Any which ways, the last thing that I would want to point out on that is even if the macro becomes tougher, I think our industry has good prepositions and Persistent at large. If you look at the last 5 years as well, we've done well both in good macro and in tough macro. So I'll leave it there.
Okay, let's talk about healthcare. That revenue growth was soft, just about up 0.4%, and that's about 28% of your overall revenues. You spoke about DOGE, USAID. Was there any impact on account of these particular factors? What is happening? What led to the slower growth? And when should we expect a recovery in the healthcare vertical?
Yeah, so if you look at our healthcare vertical, there is right from the pharma to scientific instruments, medical devices to payers and providers. Now, a part of these ecosystems are also dependent on things like the various US government funding for research, etc., and so on. And so when that gets paused because of USAID or the DOGE part coming in and kind of optimizing, there is a certain amount of softness there. We did see softness in one or two of our customers, and that led to a little bit of degrowth in those customers. But overall, if I look at our pipeline, if I look at our set of customers, if I look going forward, I think we'll sail through reasonably well. Healthcare has done very well for us in the last 6 quarters. This set of next 3-4 quarters, we believe banking, financial services, followed by tech, would be the growth drivers, and healthcare will be a little soft, but it will still continue to grow well for us.
Mr. Kalra, there are a lot of managements who've come to us and they've told us that FY26 will be better than FY25. What do you feel about that? Will FY26 be better for Persistent, especially given that the annual contract value last year was up 12%, top line also grew by 18 to 19%? Does that add to your conviction?
So, look, I don't want to give any forward-looking guidance, but if you were to sum the overall things, we announce two things. We announce an annual contract value. We announce a total contract value. The total contract value is contracts that span more than 12 months. The revenue realization from that is over multiple years. If I look at the persistent revenue that we deliver on a quarterly basis, it's the sum of what converts from an annual contract value and these multi-year deals. So we are fairly, happy with the kind of backlog we are entering the year with. Obviously, the macro is tough. You've seen our peers announce their results. We've done relative outperformance for the last 5 years, quarter on quarter. This is the 20th quarter of sequential revenue increase. We'll let the macro pan out, but we are reasonably confident of continuing the growth journey.
Okay, reasonably confident of delivering another good year. So just trying to still get you back to talk a little bit more about FY26. When you say reasonably better, is it going to be as good as FY25? Will it be better?
So we don't give forward-looking guidance. The year has started off well. We'll let it pan out. There are two parts to it. If you look at the revenue side of it, we are growing at a fairly healthy clip as compared to our industry. We delivered more than 4% sequential growth, where if you look at our bigger peers, you can look at yourself the kind of growth people have delivered. Second part of it, we did not just deliver the revenue growth, we delivered 15.6% in EBIT compared to our full year of 14.7 and last year of 14.4. So we are entering the year with a reasonably good growth. We are entering the year with a fairly strong EBIT profile, which we are confident of maintaining. So net, we are confident of delivering another year of outperformance. Obviously, we live in the same macro as everyone else does. So if the macro deteriorates, the growth rates may taper here or there, but on a overall basis, we are fairly confident of delivering for the next several years good growth.
Right. Mr. Kalra, your margins improved 70 bips this quarter around. Can you attribute the factors what led to this?
If you look at the margin performance, we have been saying we have invested ahead of the curve in sales and marketing. So if you look at our sales and marketing headcount, even over the last 4 quarters, it's in a very narrow band. While we have delivered in excess of $225 million or thereabouts in incremental revenue over the year. So that gives us a SG&A leverage. If you look at our utilization, we started the year with 81-82% utilization. We ended the year with 88% utilization. So there's a significant amount of utilization. And that utilization, please keep in mind, there are not too many companies that are growing. A lot of companies are degrowing. They are in fact reducing headcount, whereas we are one of the few companies that are growing, adding headcount. Even in this quarter, if you look at it, we added more than 600 plus team members globally. So if you look at whether it is the revenue growth that gives you a leverage overall over many different costs, sales and marketing leverage, whether you look at the forex side of it, whether you look at utilization, every part of our business is kind of kicking in high gear.
Got that. So now talking about your margin guidance, you had said that you want to improve margins by 200 basis points from FY25 to FY27. Now in FY25, that's the first year, you improve margins only by 30 basis points, which means the heavy lifting of improving margins, if you want to achieve your guidance, has to be done in FY26, FY27. How do you feel about that and how will you go about it?
So devil is always in the details. Quarter 4 EBIT is 15.6%. Full year is 14.7%. If we maintain the trajectory at 15.6% over 14.7%, it is right there a 90 basis point improvement. Now, obviously, our endeavor would be to deliver better than that. We are not giving any guidance, but that's our aspiration. So if we do that, we would have delivered the first 100 basis points improvement over the year. And then obviously, as we go along, and look, all of this is subject to the macro. We live in the same macro as everyone else does. The same tariff regime, the same negotiations with different countries and so on, which we hope will settle down over the next 2, 3, 4 months. And hopefully, our play, even on cost optimization, should play out well. So from that perspective, keeping the utilization where it is, having a better leverage of SG&A, growing SG&A at a lower pace than overall revenue growth, and overall maintaining the same discipline of growth. That should pan out very well for us.
Right. Mr. Kalra, you've been maintaining for a while now that you would be achieving this FY27 annual revenue of $2 billion and FY25 revenue goal, or FY31 revenue goal of $5 billion. Now, despite all of these tough macros, all of this tariff-related uncertainty, the worries of recession in the US, what's driving this confidence for you to maintain this guidance?
Let me answer in the reverse order. COVID year, everyone in our industry degrew. We grew by 12.9%. Our CAGR, compounded annual growth rate, is upwards of 24% for the last 4 years, compared to the industry at less than 8%, maybe in the range of 6%. So if you look at it, we have delivered 20 sequential quarters of healthy growth. That's point one. Point two, if you look at $375 million plus that we have delivered, $375.2 million, you multiply that by 4, it is $1.5 billion plus. That is the starting entry point for the year. And we have 2 years to go from $1.5 billion to $2 billion and then build up from there. Now, we have very clearly said we do have a good capital allocation strategy. By the way, we declared dividend of 15 rupee as the final dividend. So getting the overall dividend to 35 rupees for the year, which is roughly about a 40% dividend payout ratio. We have a good capital allocation for acquisitions, and we will look at maybe a scaled acquisition in Europe, tuck-in acquisitions in the US to build capability, and horizontal use cases in Gen AI, like we did in contact center with the Starfish acquisition that we did. So what we are saying is there's a good organic revenue build. We may layer it up with relevant acquisitions, and that's part of the entire building the business for the longer term towards the $5 billion. So relatively confident delivering $2 billion on the path to $5 billion. And as we go along, we'll keep giving you updates.
Sandeep, always a pleasure chatting with you. Thank you for joining in. That's Persistent continuing on its high growth path. Even in Q4, when most of the large cap IT companies reported a top line decline, a revenue fall quarter on quarter, you had Persistent growing at 4.5%. And they're saying that, of course, all subject to macros, but even next year should be a year of outperformance for the company. And they hold on to their guidance of $2 billion of annual revenue by FY27, $5 billion by FY31, and also improving margins by 200 basis points over FY25 to FY27. And they're confident about margins, holding on to margins, at least at current levels for this year. So that's Persistent for you. Get into a break. As we do that, here is a small programming note for all our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SMEs that are pushing the boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code now. Submit your entry for the SME Champion Awards Season 2.
How do you create a moat around yourself? How are you different?
So I remember in 2002 or 3, I opened my Demat account.
Huh.
And the person did not even kind of entertain me. So I was in chappal, and just a student, you go there and so kala come to and so on. And then after conviction, after some convincing, fill the form. 2 days, 3 days, and open my account. By the time you're gone, your interest is lost.
Yeah.
So the point was you find one problem area at a time and then kind of figure out that you have this right to win in this market.
What your data is telling you at this point in time about the investing culture?
Mutual fund used to be very low, by the way, in low single digits. And now it is at high single digits. Stocks used to be high single digit and it's slightly higher single digit.
Yeah.
Indian middle class, very large, and we are at around the 70-80 million mark.
What are the top 3 things that you will never do?
We will not do e-commerce, unregulated products. We will not do anything which is not good for the customer.
Welcome back. Time for an exclusive conversation then. Tata Power's MD and CEO Praveer Sinha believes that the DISCOM privatization is the last key change that needs to happen in the power sector. Now, in an exclusive conversation with Shireen Bhan, he also spoke about the solar rooftop opportunity, power demand and pricing trends. Listen in.
Let's talk about the solar rooftop scheme, Surya Ghar, and what has that meant for you as a company? But more importantly, what do you believe it means for an economy like ours?
So, I think the PM Surya Ghar program is a very, very good program and a very powerful program, which actually brings the access of power to everyone in their homes. So whether it is in urban areas or rural areas, everyone can generate power and use it for themselves, and in some cases they can also supply to the grid. So I think that's a very unique program that the Prime Minister has started, and we strongly believe that it can actually democratize the use of power. And this is a big thing, because the empowerment that you provide to people, where you don't have to actually depend on the grid or depend on an external source of supply, where you can generate your own power. For Tata Power, this is a very big initiative, because we have been into rooftop power for many years. We are the biggest right now. We have nearly 150,000 consumers who have set up nearly 3,000 megawatt, 3 gigawatt of rooftop power. And we strongly believe that the type of reach that we have in the country, and it's right across the country.
Geographically, yeah.
More than 500 cities we are there. We will be able to play a very, very important role. And for us, it's not just about giving them the equipment, but it's also about operating them and giving them the benefit of what Har Ghar Solar program is there.
Let me also ask you about where you find the DISCOM privatization story at this point in time. We, of course, have some examples in the country where DISCOM privatization has worked. There are state governments at this point in time that are looking at DISCOM privatization, and you, of course, expressed your interest in being able to play a part there. Any updates on where things stand, for instance, in UP, etc., which have, of course, expressed their intent?
So I think that DISCOM privatization is the last key change that has to happen in the power sector. There has been a delay in the way the privatization or public-private partnership should have happened. But I do see now traction, because most of the DISCOMs are going through huge financial crisis. The total losses of all DISCOMs put together is something like 6,50,000 crores, and it keeps on adding every year by 60 to 70,000 crores. So there is a huge financial stress in the distribution companies throughout the country, excepting for the state of Odisha, and then some of the smaller places like the Union Territory of Delhi, and then some of the cities in India like Calcutta and Mumbai. Most of the cities or places are still being controlled by the state DISCOMs. And I think that big change and transformation has to happen. I don't think states can continue to have the financial burden that they have. UP is, of course, first off the block. We do see that at least 2 of the DISCOMs in UP are looking to have a public-private partnership. Apart from that, I do know that some of the other states are also looking at this opportunity, and I think it's a matter of time that this will happen. Also, I think there is a great awareness amongst the government and the policy makers that you need to bring in more competition, and there can be more than one supplier of electricity. So to that extent, they will bring competition in having more than one supplier, and you can have the option.
Give the consumer the choice.
Yeah, absolutely. Of using one supplier or the other, depending upon the type of service that they provide and the quality of service that they provide and the tariff that they provide. So I think it will be a unique experience for consumers if this gets unbundled.
I mean, you know, as a consumer, I would love to have that experience, but do you think I'll have to wait 5 years, 10 years to be able to experience that future?
I think this will happen in next 1 to 2 years.
1 or 2 years? Yeah. Really? What gives you the optimism and the confidence?
Because, as I mentioned to you, the financial losses are humongous, and it is time that many of the DISCOMs took the bold decision of going through the reform. We did it in Odisha, and it has really become a benefit to everyone. The government has benefited because the losses that they were incurring is no more there. The consumers have benefited because they are getting much better quality of service. And the DISCOM employees have benefited because they are now more empowered and they get to use state-of-the-art technology to provide better services. So I think there is a general benefit and a general sense of happiness right across the sector over there. And this should also get translated in other parts of the country.
So when do you expect UP to tip over?
UP is in advanced stage in terms of the bidding process is expected to start in this month, and I think by the end of the year we should have some results. But many of the other states also are looking at it, and I do hope that they are able to take a decision sooner than later.
Well, that certainly is going to be something to watch very, very closely. But, speaking of trends, I want to understand from you where we find ourselves as far as power demand is concerned. I mean, we're in peak summer now and, electricity is being used up at this point in time. What do you envisage as far as power demand is concerned?
So India's power demand, both peak as well as energy, has grown by nearly 5 to 6%. In fact, in 2 years, it grew by 8 to 9% in 2022-23. And I do believe that this trend will continue because we have a very robust industrial growth that is happening. We have
a growing economy.
And a growing economy. And there are more number of people who have now the money to buy more electrical equipments, more gadgets. Everyone has more mobile phones, more televisions, more air conditioning and all that. Climate change is also impacting where people use more electricity, especially during summer months. So I do believe that the growth of electricity will continue to happen. Last year we had a peak of 250. This year they're talking of a peak demand of nearly 270 gigawatt. I feel that we are geared up. Of course, there are certain time blocks in the evening that we have a shortage, but those are very, very small shortages. During daytime, we don't have shortages. Fortunately, we have a lot of solar plants which have been commissioned in last few years, and last year also we had nearly 22, 23 gigawatt of capacity add.
With what has happened on solar, what do you believe we could be looking at over the next 5 to 10 years in terms of pricing?
So I think the past prices have stabilized a lot because the basket of supply that is there has now more of renewable capacity, and renewable power, as you mentioned, as the prices have come down drastically, whether it is solar or wind. And we do also see that this prices of battery storage is also coming down. I remember about 5-6 years back, we were at $1,000 per kilowatt hour. Now we are talking of $100, and so it has reduced drastically. And with more and more of clean energy solutions coming in, like pumped hydro and also with nuclear, I do expect that the power prices will virtually stabilize and remain more stagnant rather than the type of escalations one would see with whether it was with coal or gas or oil.
Tata Power in an exclusive conversation there with Shireen Bhan. By the way, just a few minutes earlier, there were flashes on your screen on Devyani International, where the company's board has approved the acquisition of an 80.7% stake in Skygate Hospitality, and that will be done for a consideration of 419 crore rupees. Now, Skygate is the owner of brands like Biryani by Kilo, Goila Butter Chicken, and the Bhojan. And this 419 crore rupees, they also plan on raising through a preferential issue of shares. They are going to issue close to around 2.5 crore shares to almost 80 shareholders on a preferential basis, and that will be used to raise 419 crore rupees, which will be in turn used to fund this acquisition. So an acquisition announced there by Devyani International, 419 crore rupees. The stock at the highest point of the day now, 1.5% higher. Take a short break. We come back with markets, and Aditya Agarwala of Invest for Edu joins in with some trading ideas as well. Welcome back. 70 points lower on the Nifty, almost 270 down on the Sensex, but there is plenty of stock-specific activity both on the upside and the downside when it comes to the broader markets. Nugent Software is the top gainer on the Nifty 500, now 14.5% higher. So it is IT and pharma that's doing well on the upside. It's mid-cap IT and mid-cap pharma that's doing well for itself. Nugent Software is up 14. Sonata Software is up 14. Natco Pharma from the pharma space is up 12.5. Wockhardt is up 7.5. So it is these mid-cap IT and pharma names that are ruling the roost on the upside in today's session. On the downside is a mid-cap pharma name as well, but that's an earnings reaction. That's Syngene, and that's the top loser on the Nifty 500 index. And of course, 12.5% lower now, extending losses from the earlier trade. Had opened in a 10% circuit and now is trading lower by 12.5%. Now closing in on that 52-week low for Syngene, 12.5% lower. But Aditya Agarwala of Invest for Edu is joining in now. Aditya, good afternoon. Thank you for joining in. We've taken a bit of a pause after a 7-day run. I would say that's par for the course, but what are some of the important levels now that you are watching out for on the Nifty? Would this 70-point dip be enough for a re-entry, or would you wait for longer? And couple that up with your stock recommendations as well.
Yeah, good afternoon, Hormuz. Thanks for having the show. Oh, definitely. I think a bit of a pause and a cool off is much required in the market after a 7-day up move on a trot. And it's been a massive up move if we look at it. And I don't think so 70-point correction warrants you just yet to go into the market and go in with long, specifically on the Nifty and the Bank Nifty. Both, I think, will enter into some kind of a consolidation, maybe some bit of extended correction as well. So if we talk about Nifty, on the downside, 24,000 is acting as a major support on currently. If that is broken, I think another 150 point correction can be seen in the Nifty. Similar for Bank Nifty also, I think it is trading at overbought levels, and we have seen markets facing resistances on the Bank Nifty front as well, closer to about 56,000. On the downside, I think 54,000 to about 53,000 is something that the Bank Nifty can also test. So I'm not too bearish on the market, Hormuz, but I think markets will enter into some kind of a consolidation, time-wise cool off, you can say, both on the Nifty and the Bank Nifty, while sector rotation is what we are witnessing, and that is likely to continue. So what started off with FMCG at the start of this rally is now moving to IT and select pharma names as well. So I think the leadership is changing, and you will not see money getting pulled out of the market. In fact, there will be a sector rotation that is going to happen, and that is likely to continue in the markets as well.
So is that sector rotation part of your stock-specific ideas as well?
Definitely, Hormuz. I've got a couple of buy recommendations, one from the cement space and one again for the pharma space. From the pharma space, I like Divi's Lab. Though the stock is already up 5% in today's trading session, but it's on the verge of a breakout into an all-time high territory. And I think from here on, you can see easily 9 to 10% upside in the stock. So for Divi's Lab, currently I'll be a buyer in the stock for a target of 7,000 on the upside. Place a stop loss somewhere around 5,900 on the downside. From the cement space, I do really like Ultratech Cement. I think so it is on the verge of a breakout into an all-time high territory again. After all, the UN cry, stock is again back at its levels, all-time high levels. So on the upside, I'm looking at a target of 12,900 on Ultratech Cement. So at current levels, one should look at getting long on Ultratech Cement. Place a stop loss somewhere around 11,900. I think that is a strong support. So Ultratech Cement and Divi's Lab are the top two bets for me within the buying space.
All right then, Aditya, thank you so much for joining in and sharing with us your views on the index and specific stocks as well. Divi's Laboratories, one of Aditya's recommendations, now at the highest point of the day, 6% higher after a positive brokerage note coming in from Citi, where it raised its price target on the stock and to well over 7,000 rupees. Take a short break. Up next, Rakesh Nair of Supreme Petrochem joins in to discuss the fourth quarter earnings performance. Stay tuned. Welcome back. And earnings reactions continue for us, and Supreme Petrochem is the next management joining in on the show. It was a weak quarterly performance from them. The margins and profits were under pressure as well, but the company managed to achieve its FY25 volume growth guidance. To discuss this and more, we're being joined by Rakesh Nair, who is the Executive Director at Supreme Petrochem. Mr. Nair, good afternoon. Thank you so much for joining in. For growing for a better part of this year, growing between the high teens to the high 20s. Fourth quarter was a bit disappointing, right, at a 2% negative growth. What do you attribute this to, and do you see that just as a one-off and expect growth to return in the first quarter and so on in FY26?
Good afternoon. The last quarter, the margins were down because the global deltas were weak, particularly when the uncertainty on the tariffs and other things arose. So the deltas have been low, and that as a consequence of that, the Indian deltas were also low. But for the year as a whole, we have done well. Our profit has grown by 12%. Our volumes grew by 9.5%. And now going forward for the year 25-26, at the moment, though we plan to achieve a growth of around 13-14% in the volumes, but then we really don't know going forward if the tariffs cause any confusions or in respect to any disruptions in the market that may impact the volumes.
So have you factored in this tariff picture for your full year forecast, Mr. Nair? What is the current situation that you're witnessing on ground? How is demand currently shaping up? You mentioned about weak deltas in the fourth quarter. Has that percolated into the ongoing quarter as well?
The weak deltas globally at the moment, yes, they are there. Domestically, it's normal deltas at the moment. But then exports remain an uncertainty going forward this year we don't know how the trade flows will be and how the supply chains will move.
So at least for the first quarter, would it be fair to say that a double-digit growth in your top line is unlikely considering the factors that you're highlighting?
I wouldn't talk about the absolute numbers in rupees, but then in volume growth, we expect that we should be in line with the last year.
How are the current raw material prices shaping up, Mr. Nair, specifically for the styrene monomer prices? What is the pricing trend that you've been witnessing? They've been on a downtrend since March. So what's the current pricing scenario that you're witnessing?
The prices are further falling now. They have dropped since March, almost over 10 to 15% they have dropped.
And do you expect that to continue?
No, I don't think, because all is linked to the crude prices as well at the end of the day, and if the crude is stabilized, these prices would also stabilize.
You've historically also spoken about being a high double-digit growth business, be it on the top line front, be it in the EBITDA front, even for the margins. Margins also, now they've declined from 18% in that you had done in FY22 to around 9%. But by when do you expect normal levels to return? Do you see that 18% that you did in FY22 being a distant this thing right now?
See, FY21-22, that is the 22 one, I had said in the past also, that was an aberration because of the global freight rates were very high. The global plants some of them were shut down. So the deltas internationally were very, very high. And we also had an advantage of that. And that is how the operating margins were high in that particular year. That particular year was actually an aberration. And the operating margins have been in the lower double digits or very high single digits then. So around 10 to 11% operating margin is what we generally expect in this business.
Right. You've achieved the upper end of your volume guidance for the year, Mr. Nair. It is around 355,000 tons. And you are expecting a 13 to 14% volume growth this time around. How do you plan on achieving that?
See, our new capacities will be added this year. So some volumes will come from that and some growth will be in our existing volumes.
Right. And there has been a large increase in inventories during the year, but do you see that as a cause of concern, or do you see that as a one-off and things to normalize? And how are you managing your inventory costs as well this time around?
See, those inventories are not our finished goods inventories. They are the raw material inventories, and they are the raw materials which are in transit at the moment. And that number, because of some bunching of supply, that number happened to be large, and that is reflecting as high inventories in our books.
So
there is no cause to worry on that account.
So you expect them to normalize going forward as well?
Yeah.
And one final question, Mr. Nair. What is the kind of revenue mix that you're expecting this time around, breaking it apart from domestic to exports, and considering the export uncertainties that you've highlighted? Would you pay more emphasis to the domestic market this year till the export scenario normalizes?
No, we will still concentrate on exports to grow, apart from growth in the domestic market. But then what I said was that the tariffs may cause some disruption there. We, rather in our internal budgets, we expect that we will be able to achieve maybe better exports if going forward the tariffs come in. We would be better placed vis-a-vis China or other Southeast Asian countries or East Asian countries.
So what is the kind of mix that you are expecting between exports and domestic?
We would have almost say 15% in exports and 85% will be our domestic.
All right, Mr. Nair, thank you so much for sparing time and joining us today on the show. Wish you good luck for the rest of the year as well. The management there of Supreme Petrochem expecting the styrene monomer prices have dropped by 10 to 15% since March, but they expect those prices to stabilize, and also a statutory warning that the tariff disruptions may cause some impact on the volume growth. But of course, all of that currently is in an uncertain territory. The plan also is to achieve 13 to 14% volume growth in FY26 after achieving the upper end of their guidance for the current financial year. Still 70 points down on the index, but we take a short break. More on the markets on the other side. Stay tuned. Welcome back. It's an earnings heavy day today, and we have already seen two FMCG heavyweights report numbers, be it HUL and Nestle. Both of them have given up gains after their results. HUL too down to the lowest point of the day, now 4% lower. Then the other big one reporting results today is Axis Bank, and Abhishek is here with the street expectations. Abhishek.
Well, Homas, to begin with, Q4 FY25, the NII growth could be one of the lowest that you are seeing in last 28 quarters as per our poll, which is a sum of all the analyst prediction over here. So the key thing to watch is that sequentially the business momentum could be very strong. Now, Citi expects deposit growth of around 9% YOY and 7% quarter on quarter, while they expect the loan growth to be at 10% YOY and about 5% quarter on quarter. So 7% deposit growth on a sequential basis and 5% sequential loan growth will be seen closely. Net interest margin may decline on a YOY and quarter-on-quarter basis. Kotak Securities estimates a 20 basis point decline YOY and 15 basis point decline sequentially in net interest margin. However, what we have seen with other private banks is that the CASA ratio has improved, and that's helped the net interest margin remain at healthy level. Will that come up with Axis Bank needs to be seen closely. Provisions are expected to decline quarter-on-quarter. Kotak Securities estimates more than 27% decline on a sequential basis in loan loss provision, that is credit cost. Now, slippage is also expected to decline sequentially. Again, Kotak Securities estimates a slippage of 5,000 crore in Q4 FY25 versus more than 5,400 crore in the previous quarter. Asset quality expected to improve. Citi estimates gross NPA ratio at 1.4% versus 1.5% in the previous quarter, and net NPA ratio to improve by 10 basis point as well to 0.3% versus 0.4%. Watch out for management commentary with respect to road ahead, especially on the business growth front. So our poll suggests NII growth of 5.5% YOY and about 1.4% sequentially. We are working with profit decline of more than 5% YOY, but it can increase 7% on a sequential basis. Back to you.
Of course, the expectations are also high after the results that HDFC Bank and ICICI Bank delivered. So all eyes on Axis Bank later this evening. Abhishek, thanks a lot for that. Just a flash on your screen a few minutes ago about a massive fire taking place at one of BHEL's unit. Keep an eye out on that as more details emerge. But earnings reactions, and we just spoke about Syngene a few minutes ago, and it's still the top loser on the Nifty 500. While on the flip side, Divi's Laboratories is doing very well for itself after that strong positive note from Citi. Vinny is here to break down both of these stocks for us. Vinny.
Hi, so yes, in terms of Syngene, weak set, not weak, but a miss in terms of the numbers that came in from the revenue front of the company. Other than that, the margins as well as the profits were in line with what the street was expecting. So yes, revenue growth of around 11%, margins at 33.7% versus 34.5%. We saw contraction coming in terms of margins. But the important thing is the outlook for FY26, which the company has given, where they're saying that they expect the revenue growth to be in the mid-single digits. They expect the base business growth to be in early teens, but that is going to be offset by the inventory destocking that the company may see. Now, margins, they expect that also to moderate furthermore from these current levels of, that we're seeing of 33.7%. They're expecting that to moderate further. Why? Because they're expecting higher OPEX expenses of the new facilities and plants that they have been opening and they're focusing on. So that OPEX expense will be higher, and that is why the margins will be lower. We could see an impact coming in terms of profitability in FY26 as well, and that could be lower as well. But as of now, inline numbers, nothing exciting because the guidance was weak, and that is what led to the fall for the company. In terms of overall Lupin, why we're keeping an eye out on this one. Now, Lupin has said that they have launched and they've actually received a final approval for the drug that they were talking about, the generic drug that is called Tovlaptin. Now, this drug is actually with a 180-day exclusivity. They'll be the first to file on this front, and that is why there's a big positive for the company. The market size of this drug as of 31st December 2024, the annual sales were around $1,467 million for this. So analysts are expecting Lupin to get in a revenue opportunity estimated at around $150 to $200 million in FY26, and this could contribute to 25% to Lupin in FY26 going forward. So a major contributor that could come in from this drug, an important one for Lupin.
Important one for Lupin indeed. Pharma has been in focus through the day, be it mid-cap pharma and some news coming in for some of the large-cap pharma stocks as well. Take a short break. On the other side, Manisha Gupta joins in with David Kelly, who is the CEO at the Natural Diamonds Council. Stay tuned. We'll be right back.
Welcome back, and joining us on the show now is David Kelly. He's CEO at Natural Diamond Council. David, I thank you so much for joining us here in our CNBC studios. With the gold prices at all-time highs, would you say that this is a time that people are buying more of diamonds then? Because gold is out of reach, but diamond clearly, while is appreciating, hasn't really done up.
Yes, obviously, to a certain extent, the gold. Here in India and China, the gold market affects more directly the prices and diamond sales. But in the biggest market in the world, there has much less of an influence of gold prices in jewellery on the sales of diamonds.
David, the last couple of years haven't been so great for natural diamonds because we've seen lower demand growth in China and US, both of these major markets. Are those numbers improving now?
Yes, I mean, the numbers in the US market, the US market's the biggest market in the world. It's around half of all diamonds sold are sold in the US market. In that market, up until the end of last year, the big diamond retailers had a very successful season selling natural diamonds. Predominantly their customers buying from Wealth, and Wealth has done historically over the last few years very well in the US. And that really continued through until the first quarter. The first quarter of this year, the US market was up just over 4.5%. So the trend in diamond sales in the biggest market of the world is still doing well. Okay. Here in India, we're still forecasting a 5 to 10% growth in diamond jewellery sales, which will make it the fastest growing market in the world and strengthen its position as the second largest market. And then in China is still is seeing slow signs of recovery. So it's certainly not fully recovering yet. There's still a long, long way to go, but it seems to be showing the earliest shoots of recovery for there.
And how is Middle East now looking at? Because that is a market that continues to do well over the years.
Yeah, the Middle East always seems an unusual market. It always has its completely unique dynamic in that market, and it's where people like to spend money. They get excited by new brands, innovation, etc. So the Middle East market is still innovating. There's still a lot of activity there, and it's still a strong market.
You talked about India, and you told us that India clearly continues to be a strong one, and 5 to 10% of growth. When you talk about that, are you looking at that on an year-on-year basis or this year particular?
Year on year, so 2025 versus 2024.
And are you anticipating this demand growth continuing over the years?
Yeah, I mean, I don't think in today's world any of us like to make predictions from one day to the next. I think we all feel a little less secure making predictions, but assuming the disruption that's going on in the world at the moment starts to calm down a little bit and we have more predictability in the world, I think there's nothing in the long-term economic factors or cultural factors that would slow that down.
David, for some time we've also seen lab-growns cause a bit of a heartache to natural diamond people here. Is that phase also now passing on?
Yeah, and I think now that people understand that lab-growns are a very, very big, very different proposition from natural diamonds. They're a very different market. The pricing of lab-growns is now 90 to 95% cheaper than a natural diamond. So there isn't really any confusion. There's no real overlap in there. So I think it's much more settling into a long-term, clear understanding that lab-growns are a much, much cheaper product to the real thing, which is the natural diamond.
David, we are stepping into a time and period which is going to be Akshaya Tritiya, an auspicious period where people buy a lot of gold and jewelry, and then of course a big wedding season coming in from the month of May onwards. What are you as a Diamond Council looking at India as a market? Are there plans for branding, marketing, etc. going forward?
Yeah, so there's more investment than ever being made in the India market because of the growth that's here. So us and other parties as well are investing a lot of money in this market to continue to show the innovation in diamond jewelry, continue to show the values of natural diamonds, and just get people excited. Diamond jewelry is something to be really beautiful and passionate about. So that's what we collectively all invest in this market for.
What would you say is the penetration level when it comes to natural diamonds in India, and what kind of growth are you seeing on there?
Penetration of the total diamond market. I mean, lab-grown diamonds here are still very, very small relative to the total market. So I don't have any market data specifically, but it's the very low end of single-digit numbers. So it doesn't really play. There's much more talk about it than there is actual reality of people buying lab-grown diamonds. Don't really see that changing too dramatically. So it's why we really just focus on the natural segment of the market.
A word on diamond prices as well, if I may, David. And we've seen prices hit all-time highs in 2022, and then there was a profit-taking and the prices seem to be rising yet again. I was reading some reports which suggest that this year we've seen diamond prices gain up by 10% already. How are you looking at diamond availability, certification, prices?
Yeah, so really the prices reflect the growing demand, particularly in India and the US, as I was saying. So ever since kind of February, we've seen a real bounce back in the price of diamonds. And again, we can see that continuing because the markets remain strong. Consumer consumption of diamond jewelry remains strong. So we really see this as really the kickback following the reaction to the very big growth in diamond prices post-pandemic. This is really the kickback from then that decline that came after that.
And what caratages are doing better or well, especially in the Indian markets?
Which
caratages? What carat? Are people buying solitaires? Is it smaller diamonds that people are buying? What is?
Yeah, I mean, it's across the range of qualities and sizes. I always say diamonds are very individual. There's no two diamonds in the world that are the same. So diamonds are very much about you and what you love and what you fall in love with. And so I don't really narrow it down to trends in specific diamonds because I want everyone to go to a jeweler, see the diamonds they fall in love with, and that diamond will be for them.
All right. Thank you, David, thank you for coming to our studios here. And of course, as always, weaving a story around those diamonds and emotions as well and giving us very strong numbers going forward into the market. Well, India is the second largest market when it comes to natural diamonds. And as David tells us, 5 to 10% of a growth in demand is what we're anticipating in the year to come as well, as far as natural diamond concerns. With that, let's go across to PM Modi as he's speaking at that summit there. Let's go across.
जिस बेरहमी से मारा है उससे पूरा देश व्यथित है, कोटि कोटि देशवासी दुखी हैं। सभी पीड़ित परिवारों के इस दुख में पूरा देश उनके साथ खड़ा है। जिन परिवारजनों का अभी इलाज चल रहा है वे जल्द स्वस्थ हो, इसके लिए भी सरकार हर प्रयास कर रही है। साथियों, इस आतंकी हमले में किसी ने अपना बेटा खोया, किसी ने अपना भाई खोया, किसी ने अपना जीवन साथी खोया है। उनमें से कोई बांग्ला बोलता था, कोई कन्नड़ा बोलता था, कोई मराठी था, कोई ओडिया था, कोई गुजराती था, कोई यहां बिहार का लाल था। आज उन सभी की मृत्यु पर करगिल से कन्याकुमारी तक हमारा दुख एक जैसा है, हमारा आक्रोश एक जैसा है। ये हमला सिर्फ निहत्थे पर्यटकों पर नहीं हुआ है, देश के दुश्मनों ने भारत की आत्मा पर हमला करने का दुस्साहस किया है। मैं बहुत स्पष्ट शब्दों में कहना चाहता हूं, जिन्होंने ये हमला किया है उन आतंकियों को और इस हमले की साजिश रचने वालों को उनकी कल्पना से भी बड़ी सजा मिलेगी। सजा मिलकर के रहेगी। अब आतंकियों की बची खुची जमीन को भी मिट्टी में मिलाने का समय आ गया है। 140 करोड़ भारतीयों की इच्छा शक्ति अब आतंकी आकाओं की कमर तोड़ कर रहेगी। Friends, today from the soil of Bihar, I say to the whole world, India will identify, track and punish every terrorist and their backers. We will pursue them to the ends of the earth. India's spirit will never be broken by terrorism. Terrorism will not go unpunished. Every effort will be made to ensure that justice is done. The entire nation is firm in this resolve. Everyone who believes in humanity is with us. I thank the people of various countries and their leaders who have stood with us in these times. साथियों, शांति और सुरक्षा ये तेज विकास की सबसे जरूरी शर्त है। विकसित भारत के लिए विकसित बिहार जरूरी है। बिहार में विकास हो और विकास का लाभ यहां हर वर्ग, हर क्षेत्र तक पहुंचे, ये हम सभी का प्रयास है। पंचायती राज दिवस पर इस कार्यक्रम से जुड़ने के लिए मैं एक बार फिर आप सभी का आभार व्यक्त करता हूं।